Hello, ladies and gents. Thanks for tuning in. We're stoked to be able to share this highly topical and timely session with you today. As the world seems to be going a bit mad, we're going to be taking a look at how you can play some offense instead of defense when it comes to your lending situation, to perhaps get a bit better deal with your existing lender and obviously overcome some of the challenges we're seeing in relation to rising costs, interest rates, inflation, everything going on out there. Of course, we're going to be having a look at what's happening with the residential property market, notably the likely impacts of the interest rate rises and the upcoming election, particularly, and what this all means for you. And most importantly, we're going to be taking a look at what you can be doing to protect your family against rising costs, including some specific strategies you can use to negotiate a better deal on your home loan with your current lender. We'll review the benefits of shopping around. And of course, we'll have a look at some of the traps to avoid when refinancing or applying for your next loan. By the end of the video, you'll have a clear understanding of what you can do right now today to get your family in a better position. And of course, joining me today is lending expert Chris Booth. Chris is considered by many to be a residential property and lending expert, having spent close to 2 decades helping young families and property investors to secure the best lending options in the market. We hope you enjoy the session, and as always, feel free to reach out with any questions. Chris, thanks so much for joining us today.
Beautiful. That was a big wrap, Tom. I'm nervous now. I was all right before. You can't surprise before I've not said anything. So anyway, funny.
Oh, fantastic. Well, mate, the world has gone a bit crazy in the last couple of months with everything going on out there. We've obviously got a war in Europe. We've got interest rates rises that are happening for the first time in a long time. We've got the impacts of inflation that are being felt. What's your read on the market, mate?
Yeah, I mean, look, it's certainly, very uncertain. I think many of these things which have, come together and sort of popped up, they've also, all these forces have sort of come together all at once, So we've got, the rising cost of fuel, and that was a struggle there, a couple of months ago where we're paying over $2 a barrel of, $2 a litre of fuel at the Bowser, right? So that was a big one. Then we were talking about forecasting interest rates going up over the maybe next year, but that's certainly been brought forward. So that's a big impact to us as well. Inflation has really risen its head in Australia and globally. So, and that's caught many people by surprise. I think that's that's something which I don't think we could have expected sort of 8, 9, 10% in the States like we did. But there's and then lastly, sort of coming out of coronavirus as well, what's the new norm for working people, and also managing coronavirus as an everyday thing. The impact from an employment perspective has been pretty huge. I think I've been locked down for 5 weeks with my family. Each week one of the kids get it, and then I got it last week. But all of those things have sort of come into the mix a little bit. So pretty uncertain. But as you said before, the interest rate side of things, we are part of that tightening cycle for Australia now, and the Reserve Bank of Australia has been pretty clear about what they're looking to do next. So interesting times for the next 6 months, I think.
Absolutely. And it is interesting, isn't it, to be a couple of years on from, I guess, the first wave of the pandemic. And, I recall at that time, my phone lighting up with questions from friends sort of saying, look, what's going to happen? I've been close to the property and property investment space for a long time. And I just said, look at what the economists are saying. We've got the smartest people in the country who are tracking this and predicting all sorts of things. And if I recall correctly, the range in the projected downturn was like 20 to 40%, at the start of coronavirus. So it's, the market's going to come off and it's going to be catastrophic. And it feels like that's obviously been long forgotten. We've had a couple of years of really substantial growth, quite the opposite of what was being predicted. This time around, with I guess some of the updates from the RBA and naturally the economists who are tracking those movements. What is the current view in terms of the next 12 months, the next 24 months from a property market perspective?
Yeah, I think, look, interestingly, the RBA has brought that increase of interest rates forward a little bit more so than what they were thinking previously, and they've also unwound a lot of the fiscal stimulus, i.e., putting cash into the system to support the banks. So the banks are now the banks are now having to support themselves by borrowing money in the interbank market, which is a little bit more expensive. And secondly, now we've got this increase in interest rates, which means that there is going to be an on cost to the consumer as well. Not picking any economists out, but I get a regular blog from St. George Bank every day, which I really like. And those guys there are fairly conservative in their thought process, but they do believe over the next sort of 6 months we'll get to maybe like a 1.75% cash rate, which I think would be reasonable. Between now and sort of the end of next year, middle of next year, I think we should be reasonably expecting the cash rate to be at 2%. So, that cost of funds will obviously have to be passed on to consumers when they're borrowing money. I suppose on the flip side of that, though, it'd be nice if you've got some term deposits to actually get an interest return on your money rather than nothing right now. So these things are all balanced out. But yeah, certainly I think in the by Christmas, I think we'll see 1% as our cash rate, and then with a continued increase to the middle of next year as well.
Sure thing. And I guess with consideration of where that cash rate may end up, you mentioned 2%. What's your view on the typical, I guess, buffer that the banks are putting on? That they've obviously got to make a margin on the money that they're lending out. What would that, what could we expect that to look like for consumers?
Yeah, I mean, it was actually reported the other day. So 2% is sort of ballpark. And in fact, the banks have actually reduced their net interest margin on their products they're providing over the last couple of years. It's, I think, CBA just under 2% now, whereas traditionally they were over 2%. So 2% on top of that would be sort of reasonable. So, your 4% interest rates is going to be the new norm in the next sort of 6 months. And if you look at the fixed rates, they've already taken the steps to be increased to represent the future increases in interest rates which are happening now. So variable is still, you're still seeing some low interest rates down at that 2%, 2.4%, but the fixed rates are already priced in the future increases which we're expecting over the next sort of 6 months. So again, it's interesting times. And there was an article by a Macquarie bank economist, I forget his name, I should have had it written down, but he believes more so that we're going to go up quite quickly, and we'll see interest rates at that 2% quite quickly. But then he feels that we'll need to then sort of relook at fiscally stimulating the economy again. He feels that the economy will stall, and therefore the RBA will then have to reduce interest rates. So it's just another element of us to consider this, but yeah, certainly I think by Christmas we're looking at sort of a 3.5% interest rate for the average owner occupier loan.
And I guess what would you say to people out there who have perhaps read some of the headlines that are out there, obviously heavily dramatized around the impact to the overall market, and properties flooding the new listings and realestate.com. I guess with consideration to the growth in prices over the last couple of years and where debt levels sit within households, what's your sort of take on those views that are out there at the moment?
Yeah, I mean, it's interesting. So property wise, I mean, we've still got a swag of clients with pre-approvals in place, and we've been rolling those pre-approvals for quite a while to try support them to find their own family home or investment properties or whatever it will be. And they've really struggled. The auctions were red hot at the end of last year, and some crazy prices happening. But that being said, this week we've got a client who's searching, in the Randwick area where I'm actually from, and hunting for a property there. And even though the property never got to the auction, there was definitely a Dutch auction behind the scenes with making a market before the market, and that was quite interesting. And this property was listed at I think it was $2 million, and then going for sort of $2.4 million. So so still properties are I feel are selling, and there's still an appetite for people to buy. Affordability from a credit perspective is still reasonable. So as you said before, the impact of coronavirus for many was minimal, with regards income and bonuses and commissions and things. So we've still got strong borrowers. We've got equity in property, like if we're sort of crossing into gear, clients have got a lot of equity, increases of sort of 25-30% in their homes over the last year has meant that they've got a lot of equity to then use that equity to invest. So the borrowing climate right now is reasonable, and the assessment rates for borrowers as well is its all-time low. So when we're going to market to borrow, a 5% benchmark rate is used to assess affordability. And obviously that's statistically extremely low right now. So affordability is there. There is still demand for property. There seems to be a lot more property on the market. I think that's something which is good. I think it just means that we're just looking to find where that sort of new buyer seller norm is right now. And I think auction clearance rates are obviously down, but I do believe the properties are still selling behind the scenes.
Sure. Yeah, it certainly sounds like it's a much healthier picture than perhaps you'd be led to believe on news.com.au or some of those sources where it can be a little bit daunting some days, I must admit, to wake up and read some of those headlines. So it certainly seems for someone who obviously like you got your ear low to the ground, you're tracking things, and obviously at an individual client level, seeing what's happening out there, it does look like we're probably seeing a little bit more stock hit the market, but perhaps only to the point where it's a bit more of an even keel in terms of those buyers and sellers, as opposed to like you mentioned last year, it was just an absolute nightmare for anyone trying to get into the market. So interesting to see the difference in the reality on the ground versus perhaps what enters the media. I guess a big focus for us today, Chris, of course, was to try and help people who are looking to offset the impacts of rising costs. We've discussed interest rates; it's a huge factor. Inflation's another massive consideration. We've seen what's happened with petrol prices, fuel prices, notwithstanding the cut to the excise there. But what are some of the things that you see as the biggest opportunities to offset some of those rising costs?
Yeah, I think, look, I'm quite a pragmatic fellow. So aside from reading all the the news.com media and interest rates going up and problems around the world and things which are causing issues for us, I think there's real practical pieces around cash flow and budgeting, and I think that's the first part where that's the first thing that we've got to look at. So the first thing I would suggest, and there's a really good website on the Reserve Bank of Australia's website, and it's got the lenders' interest rates, and what they put on there, and they publish on a monthly basis. They put the lenders' interest rates for existing clients and lenders' interest rates for new to bank clients, and there is a big difference between the two. So I think statistically for the home loan, the interest rate that's quoted on the RBA site is like 2.9%, but new to bank money is 2.45%. So you can see there's a gap between what people are getting if they're applying for new finance with that same lender, and also what you get if you just sort of sit back and relax and take what that lender has to offer. So I would certainly be revisiting what is your actual interest rate and looking at reviewing that. And we'll talk a bit about how we can prepare for repricing, but certainly that's the first thing I would look at. Start looking around at what the actual interest rates I could get if I applied for new finance or went back to my bank and reapplied for finance. So that's the first one. The second one is looking at the cash flow of your lending as well. I think importantly, non-deductible debt, you need to be paying your principal and interest off. Okay, but if times are getting tough and you've got to really, you got to really dig deep right now, restructuring that non-deductible debt, you can look at re-extending the term of that loan. Now, I'm not suggesting that we go out there and strike another 30-year term or whatever it will be, but if we've only got 10 years left on our loan facility and our repayments are quite high, we can quite easily go out to 15 or 20 years and reduce that cash flow component of your principal and interest, and that will support some of the increases in the interest rate. So and restriking that cash flow component of your home loan with a longer term will certainly save you some money. The other one, which we're finding a lot of clients have sort of accepted the fact that their investment loans have matured to principal and interest. So many of my clients have got both home loans and investment home loans, and the cash flow structure is best served where the home debt is principal and interest repaid, and the investment debt is interest only, because obviously all that surplus cash that you've got on a month-by-month basis is better placed into the home loan. So having a look and revisiting the cash structures and the interest type and repayment type of your loans is very, very important, and getting that reviewed. And again, the benefit that can be, quite marked. If you're paying interest only on an investment loan rather than P&I, the savings of that then will certainly support you, and you can actually try get a bit ahead in your home loan. So those are some things there with regards to structuring your debts, I think, which we can review as well. And the other one, which a lot of us have sort of creeped up on, car loans and credit cards, right? So many of us have kind of, got a car loan. It's a 5-year term or a 7-year term or whatever it will be, and the repayments of that debt are quite high. Also credit cards at sort of 15, 16, 20%. They're excessive interest rates as well. So, reviewing and doing debt consolidation, I think, is another key element of, what I'd be recommending right now. Again, buying a depreciating asset like a car, is it appropriate to have a 30-year term? Probably not, but certainly, revising and reviewing the cash flow of that car loan may be appropriate right now. If interest rates are going up and you're struggling to afford, the new interest rates, by extending that car loan term out from sort of 5 years to a 10, 15-year program might be something beneficial. And lastly, saving, if you've got a $20,000 credit card paying 15% and you can pay 3%, that's a huge saving there as well. So I would certainly, be looking at those sort of things to manage my cash flow a little bit better. And then and how can we do that? Well, we've all, if we've owned a property through the last few years, the increase in the equity will allow us to borrow against that equity to do exactly what we're talking about now. So hopefully from that sort of security and valuation of your home, the application process will be a little bit easier there as well. And then just talking about the bank affordability right now, like I said before, the bank's assessment rate for debt when they're measuring a repayment is around about that 5% mark, just over 5%. Now, if increases of interest rates happen over the next 3-6 months, as they're going to, the banks will increase that benchmark rate as well. So what I'm saying is, don't panic, don't rush, but certainly now is a good time to actually revisit all of these things, because affordability is still reasonable with the lenders and their benchmark rates haven't changed in line with the increase of interest rates expected. So this is a really good time right now to kind of get your house in order from a cash flow perspective, in preparation for the increases we're expecting over the next 6-12 months.
Some absolute pearls of wisdom there, Chris. I think there'd be a few people watching this that'd be pretty keen to get a link to the RBA site that you mentioned. That's phenomenal to think about. Obviously, the divide between existing customers and perhaps the raw deal that they might be getting from being a loyal customer compared to a new customer who the bank wants to bring on. So that's a phenomenal insight. I think particularly there, as you mentioned, reviewing those loan terms where you might be midway or towards the end of your loan term, reviewing your investment loans, particularly around the principal and interest consideration if those loans have matured beyond that initial interest-only period. And I think particularly beneficial to be looking at those personal loans and debt consolidation, as you mentioned, to bring those back from potentially a 20% rate to a 3%, as you mentioned. So some great insights there, and a really good segue, I think, to the next topic that we wanted to nail for people today, which was the all-important one of how to negotiate a better deal with your bank. It's probably a conversation that not too many people are keen to have, but in terms of, I guess, time invested and the potential return or savings, it can be a phenomenal thing.
Yeah, 100%. I think, well, look, many of us are uncomfortable speaking to our banks, even though, the bank can't change any of the terms and conditions of your existing contract, and they find out, they're asking questions to find out a little bit more about you. We all get a bit concerned and a bit nervous when we're speaking to our banks. So yeah, one of the things that we do regularly for our clients is actually speak to the banks on behalf of them. So we make a representation of our client's financial position, and that we're actually seeking a better deal for our clients. And if you don't give us a better deal, obviously the risk to that existing bank is that we will try and we'll potentially be moving your client to a different lender. So but to have these conversations, you've got to be prepared, and you've got to get your I suppose your ducks aligned, and have confidence in your conversation, and also understand what the bank questions will be. So they'll be keen to find out about where you're at financially. They'll be keen to know what your income situation is like, what your loan to value ratio currently looks like, and sort of almost do a mini review of the credit elements of your application, even though the loan is actually with them. So one of the things that we actually do at Lydian is go through a bit of a health check. So we want to make sure that we revisit all of those key components of credit. So the first one would be what is the value of your property and how much debt is associated with it. So that's your loan to value ratio. So if you've got $500,000 of loan against $1 million property, that's a 50% loan to value ratio. Now the awareness around that is that the lenders are more inclined to decrease your interest rate if it's a low loan to value ratio, and a low loan to value ratio from an industry perspective is sort of 70% or 60% loan to value ratio or lower. So if you were applying for finance today for new finance, and you had a 60% or lower loan to value ratio, you'd be expecting the better interest rates. And in fact, a few of the lenders actually review that on an annual basis and will reduce your interest rate. So some of these new neobanks like Athena, homeloans.com, some of the digital banks, they're starting to do this review process and actually decrease your interest rate in line with that LVR component. If your loan to value ratio is a little bit higher, but up to 80%, then you're sort of outside of that lender's mortgage insurance component. Well, then still you've got the ability to fight hard for your rate. So firstly, knowing what your loan to value ratio and knowing the sort of technicalities around that conversation is important. The next one, when you're fighting for a better rate, look, you have confidence in what type of application potentially you have to approach other lenders. So if you've got strong employment, you've got your debt to income ratio. What that means is how much income gross versus how much debt you have. If you've got a strong debt to income ratio, well, I'm talking about 4 times of debt compared to your income or less, you've got a strong application if you wanted to proceed with a different lender. So again, you've got the ability and you've got confidence knowing that you've got a low loan to value ratio, you've got strong income to support the debt, so financially you're very, very strong. The behavior of your credit has been exemplary, so you've repaid monthly, you've increased money in redraw or offset, wherever it be, and saved and paid extra on your home loan. So you've got a really good credit profile with that existing lender, and that then gives you the right to say, well, look, I know you're giving other people who are just joining the bank a way better deal than me. I've just told you how good I am. I'm a super saver. I've got a low loan to value ratio. I've got strong income. Give me the best deal. And that's exactly, well, we don't say it like that to the banks, but we articulate it exactly in that same sort of form as well. So you've got good credit history, good credit behavior. You've got strong income against the debt, and that low loan to value ratio, you should be asking for better rates. And the last thing to do is, where do you source those interest rates? So you can go online and look at the Rate Cities and the CanStars of the world and find out what those real cheap rates are as well. The other component of that, you need to understand what kind of product that you have got compared to some of the products which are advertised in the market. So some of these super cheap interest rates are just basic facilities, so they don't have access to redraw, no offset features, no splitting of the loan, no fixed component for the loan. So all of those features might be very, very important for you personally, and therefore fighting for an interest rate for a product which is not your product might not be appropriate as well. So you just got to make sure that you understand exactly what you're fighting for. So I mean, in summary, the best kind of tip I can give you is really do your homework first, get prepared, get confident in those kind of credit bullet points, and then make sure that when you're making the call, you're presenting those strong financial elements to get a better deal, and be confident with the outcome. So if they're giving you an interest rate and you still feel it's no good, you'd like to speak to their manager or beyond. So there's a few things there, but we do this on an annual basis for loan reviews for our clients. And I would suggest even clients we've been relationship managing for many years, we would on average save sort of an extra $500-600 a year minimum. And in fact, new clients coming to us when we're doing this repricing or fighting for better interest rates, when we've actually not supported them in the past, and they're new clients to Lydian, we're finding that we're saving sort of 0.25%, 0.5% or more in some instances. So saving, you know, $3,000, $4,000, $5,000 a year in interest rates reductions for that client just by asking for a better rate, which is cool. So there's no cost. Time on the phone is probably 10 minutes. You've got to be a bit grumpy about it, you know. So I'm an unhappy bank basher, and that's me. And hopefully you get the favourable outcome.
Yeah, it's great advice, Chris. And I think, sorry, I shouldn't say advice because none of this is personal financial advice. Of course, we've got that caveat. This is general information. You should always seek personal advice from a qualified advisor before making any financial decisions, as we know. But I guess the takeaway there is, you know, if your situation has changed, as you say, if the value of the property has gone up relative to the loan balance, then obviously puts you in a great position to have that conversation, like you said, with an understanding and having educated yourself on what some of those rates are, both for new customers of your bank and obviously from some of the bank's competitors out there. Sounds like obviously a phenomenally beneficial way to spend 10 minutes of your time. It's certainly, you know, a bit of ROI there. And, you know, the next element to that, of course, is if you know, you fall up short, the bank are unwilling to provide you with a better rate, and, you know, you feel like your circumstances have changed. You know, what are some of the benefits of, I guess, considering the other options in the market? I know the refinancing process is, you know, it's not the funnest thing to do on a Sunday, but ultimately it is something that can deliver some huge benefits. So, you know, perhaps if you could just sort of share what that might look like for someone who has been through that process with their bank, but does want to secure a better rate.
Yeah, I think going back to the conversation we just had before about preparing for the conversation with your bank, you know, we start from scratch again. So we speak to the clients, we find out about where they're at financially, you know, what's their income, what's their property, you know, what's the loan to value ratio, what's the debt against that property, what are the interest rates against that. We go to the next level. So I think, you know, high level, we're talking about now fighting for interest rates, but when we are actually looking to move to a different lender, we've got to be really confident in the data inputs that the bank will be checking when we actually make that application for finance. And what do I mean by that? Well, when we go to a bank, they will actually want to see a copy of your payslip, or they want to see evidence of the income going into account. So having a professional like a mortgage broker or even a financial planner or someone just assessing, you know, what that looks like, to sort of slice up where your income source is coming from. Is it consistent? Are you in a probation period? That sometimes have an impact if you've just moved jobs, but just making sure that all the elements around your income and employment are going to be agreeable to the new lender which we're potentially looking to introduce you to. Okay, so that's the first thing. We'd be checking those things. Secondly, there is a big component of assessment for moving lenders around your credit health. And many people don't know that the credit reporting system has changed. So a couple of years ago, the credit reporting regime, so you might have seen Equifax, Experian, and a couple of others out there, Ilion, I think it is as well. They have an agency where all of your performance of credit has been reported to, and you get a score, but also you get a behavior report as well. And it's well worth checking to see exactly what your score is. And typically it's a score out of 1,000. So, you know, if you're less than 500, that's not good. More than 500, that's okay. If you're sort of 800 plus, that's a great score. But you just need to make sure, one, of what that score is, to get an understanding about how that score is accounted for and built. And then lastly, in the credit report these days as well, it notes the repayment behavior for you. So if you've got open credit, being a home loan or credit card, and you're making those monthly payments on time, you'll get a tick in the box and a green stamp against your credit report. Now the banks will look at that to make sure that any credit that you've actually had and managed, you're managing properly, professionally, and well as they'll potentially want to see the bank statement as well. So that's something which is very important. So go back and just check your your hygiene around your credit. I think that's important, and that credit report is certainly a compelling document which the lenders will look at. The other thing that we do is get an up-to-date RP data report. So there's a company called CoreLogic. You can get a like electronic valuation, same as like the domain. So just make sure that you know what the value of your property is. Do a quick report. You know, and the report is based around statistics, not what the real estate agent for sale is going to tell you. So and that can be very different from that conversation. So if, you know, on one hand, the sales agent might sell you, you're going to sell your property for $1.2 million. The realistic price for your property from a bank's perspective may be $1 million. So we just want to know that there's going to be some equity in your property. So again, sort of preparing and checking the inputs in your file. And I think the other thing that I would suggest you look at and look closely at as well is your budgeting and expenditure as well. What are your discretionary expenses? So some lenders will actually go granularly into your savings account where you spend on your groceries, on your entertainment, your Uber Eats, your Uber cabs, and they will actually go line by line and actually build out a budget from the bank statements and not take your verbatim word about what your budget should be. So there's sometimes a big gap between what your budget should be when you've been speaking to your wife or your partner and actually what it is. So having a bit of a look at that, and if that means that you need to sort of pause and take 3 months to clean up your spending because we're looking at an important transaction, that's something that we give the guidance for as well. So just really understanding what that process is, and all we're trying to do is really increase the probability of success when we actually do decide to go to a different lender. I think that's most important. Now, lastly, once we've actually done all that preparation, all of those great rates that you see on on TV or on the websites, are you truly going to qualify for that lender? So some of these lenders have quite different credit policies, and those credit policies are different for different properties, location of properties, whether it's a regional property or a city center property, types of property, things like apartments, small apartments, studio apartments, houses. Also, the other thing to think about as well is income. So if you're getting and reliant on sort of commission on a regular basis, and that's been coming through, well, then we need to look at that. What's the consistency of commission, and will the lender allows that commission when we're looking at affordability for the debt? Other things like bonuses as well, and also looking at sort of other expenses taken out of your income and your salary as well. So we kind of bundle all that up, and then we look at what the most appropriate lenders in the marketplace. For most, we're looking at your household names, so your INGs, AMPs, CBAs, NAB, Westpac, Suncorp. I've probably missed Macquarie Bank. So we're looking at household names first, like all the good ones, and these are the guys that are giving you the great rates. But if you don't fit in their little policy, well, then we certainly have another 50 different lenders outside of those ones I just mentioned who may be more appropriate for you for whatever specific reason. And a broker will coach you through all of this as well. You'll go through that education piece, you go through that review piece when you've got all your data sets in place, and then you'll go through that piece around talking what's the most appropriate lender as well. So so that's some of the kind of the process that we go through. We try and make it as easy as possible as well. So we try to digitize much of the collection of data for you. So being with a good mortgage broker, we've got all of this information to hand.
Sure. Look, and certainly obviously a detailed process. You mentioned the assessment criteria of the banks, and I guess particularly hearing some of that, there's probably plenty of opportunities for people to, I guess, waste time in that application process. You mentioned sort of chasing those loan options that perhaps they wouldn't they wouldn't be well suited to from the outset. I'd imagine working with someone like yourself, you could identify that early on and make sure that you're putting an application forward for something it's going to be a likely home run.
Yeah. Exactly. I think some of the mistakes we do see regularly. It's very easy to get drawn into like the digital application. So you see a nice rate on the website, you start filling in your details, You sign the privacy forms, fill in the information. They come back to you, say, please send me this information. And then computer says no, and that's the last thing you want, because not only does that put a mark on your credit report that you've actually applied for finance and not actually been approved. So that's not a good thing. And secondly, you don't get chance in those digital processes to do all the prep work we talked about before. So again, that's a big pitfall I see quite regularly. And the next sort of couple of years, with the whole digitization of our lending industry, there's going to be a lot more of these accidental applications which you put in, which will get declined, because the digitization assessment is very different to what we've been used to over the last sort of 10-15 years of credit.
Yeah, it's kind of scary, isn't it, to think about that? It's not something I ever would have thought of, putting an application in for a credit card or obviously a loan online, like you mentioned. For that to have an impact on a future application is a bit of a concern. So no doubt pays to have a conversation with someone like yourself. Obviously, what we're covered off on today, and to wrap up today's session, I'd love to keep you longer, Boothie, but we've all got places to be. I think the big takeaway for me is obviously pursuing the path of least resistance initially, like you mentioned. So identifying whether you would be well suited to obtaining a better rate through your existing bank, and then if you are considering going down that path of whether it's a brand new loan, you could be a first home buyer, or someone looking to refinance an existing home loan or investment loan, working with an experienced broker who's going to help you avoid not only the pitfalls and the potential impact to your credit report, but also the time involved in pursuing options that aren't going to be a fit, and perhaps could identify that from within the first few minutes of a conversation. So appreciate all the wisdom you've shared. I think there's 20 years of experience wrapped up in 40 odd minutes. Hopefully I haven't put anyone to sleep with my brief introductions and I guess questions of you, mate. So I appreciate you sharing everything with us today. There's some absolute gold in there.
Not at all.
For anyone who is considering taking that next step with their loan, taking on board some of what was shared today, what would be the next and most important step that they could take if they wanted to perhaps have a conversation with yourself?
Yeah, perfect. I mean, so for me, really, I've been a person who's associated and partnered up with financial professionals, be it financial planners, good accountants, good lawyers, good mortgage brokers, good property consultants all my life. So who's in your deal team? So I would suggest really, if you haven't got a deal team, or if you've not got like a financial confidant or a guru in your world, you've got to find one, right? Whether that's me, yourself, Tom, but certainly I know on My Money Sorted there's a swag of extremely knowledgeable financial advisors and advisors on there. So reach out and get connected with the right person to solve or to have the conversation that you're looking to today. So that's the first thing I would do. Just look out. Or alternatively, Lydian, we've got Sydney, Melbourne, Brisbane brokers. These guys have been around for many years, lots of experience, and yeah, more than happy to sort of lock in a complimentary, free, private conversation about your finances and take it from there, really.
That's fantastic, Chris. I appreciate that, and we'll be sure to obviously include a link to obviously request a call with yourself and the team at Lydian for anyone who's interested in taking that next step with a new loan or refinance. So again, appreciate your time today. Thanks for all the insights. Thanks for all the gold that you've shared, and yeah, really appreciate it.
Yeah, thanks, Tom. Appreciate it. Catch you soon.
Good on you.